When it comes to the 2008 crisis, most people do not know AIG's role in fueling the crisis.
Troubled insurance giant AIG does have its white knight in the form of the federal government.
Yeah, the central bank is now loaning $85 billion to keep that company afloat, averting a catastrophic collapse.
After, for the second time in a month, the government uses taxpayer money to save a private company.
Yes, it is Uncle Sam to the rescue, but oh, what a price tag. Faced with the prospect of a $1 trillion company failing and the further crisis in confidence that could have triggered, the Fed decided they had no other choice. This unprecedented $85 billion loan will shore up a massive insurance company and give the government an 80% stake.
This is a very big deal because by bailing out AIG, it's essentially bailing out the entire banking sector.
AIG wasn't a flashy Wall Street bank or a hedge fund throwing money at high-risk trades. It was an insurance company. It was one of the most boring, conservative businesses you could imagine. AIG was founded in 1919, and it had grown into one of the largest insurance firms in the world. By the early 2000s, AIG had offices in over 130 countries, with billions in assets and a rock-solid reputation. So how did this big insurance company become the face of one of the biggest bailouts in US history? For decades, AIG was known for selling traditional insurance policies like car insurance, home insurance, and life insurance. These are things most people understand. You pay a premium, and if something bad happens, like a car accident or a house fire, AIG pays out. It was a reliable, steady business. However, in the years leading up to 2008, AIG ventured far beyond its traditional insurance roots into a more complex and risky area of finance, specifically through a division called AIG Financial Products. This division started selling a type of insurance known as a credit default swap. To understand AIG's role in the 2008 crisis, you first need to understand credit default swaps. I have already explained credit default swaps in detail in this video. But in short, credit default swaps are insurance on mortgage bonds. If you've watched the movie The Big Short, you know that Michael Burry and others bought these swaps from various banks. For example, Michael Burry bought the swaps from Goldman on some housing bonds. He was expecting that those bonds would fail, and he paid a premium until that happened. But the most important thing here is that Goldman did not have to pay for those swaps. It was AIG that was paying for those swaps. Goldman was just a middleman. Reality was, Goldman bought lots of loans from commercial banks. After they bought those loans, they created an MBS bond product with those loans. Michael Burry studied those MBS bonds, which were created by Goldman. He went to Goldman and said, "Hey, I want to bet money on these MBS bonds you created, because these bonds will soon fail. We should make a swaps contract, and I will pay you a premium for those swaps until these bonds fail." Goldman thought that these are housing bonds, and the housing market never fails. So they thought the premium money was free money for them. Goldman did not take the risk of insuring those bonds themselves. They asked AIG to cover the bonds if they fail. So Goldman went to AIG and asked them, "Hey, Michael Burry wants to bet against these housing bonds we created. Will you insure them and cover the cost if they fail? We will pay a premium to you, too." At the time, AIG also thought that the housing market was never going to crash, and they happily accepted to pay for the swap contracts Goldman sold. AIG has done this with almost all the major banks. So for the majority of the swaps that were bought before the 2008 crisis, AIG was on the other end to cover those swaps. The investment banks only acted as middlemen as people were betting against their MBS bonds. So when homeowners with subprime mortgages began to default, the housing market started to show cracks, foreclosures skyrocketed, and suddenly those AAA-rated mortgage-backed securities didn't look so safe. As the value of these MBS dropped, banks that had bought protection from AIG wanted collateral, a sort of down payment to prove AIG could pay if the losses continued. But AIG hadn't planned for this. The crucial mistake AIG made was in underestimating the risk. They were taking on enormous obligations without fully understanding the potential downside. They didn't set aside enough money to cover potential losses if things went wrong. They were essentially relying on the idea that the housing market would never significantly decline and that homeowners would always make their mortgage payments. At its peak, AIG had insured over $440 billion in credit default swaps. A large portion of it was tied to subprime housing. By mid-2008, it was clear AIG couldn't meet its obligations. The company had already posted over $25 billion in losses, and the worst hadn't even hit yet. Banks that were exposed to AIG started panicking. They essentially said, "Hey, AIG, these mortgage-backed securities you insured are now worthless. You owe money to these credit default swap owners." AIG, which had collected premiums but hadn't set aside enough capital for this catastrophic scenario, suddenly faced billions of dollars in claims it couldn't pay. If AIG collapsed, so would the banks depending on those CDS contracts. That included some of the biggest financial institutions in the world. Think of it like this. Imagine you insured every house in your town against fire, but you only had enough money in your bank account to cover one small house fire. If every house in town caught fire at once, you'd be bankrupt. That's what happened to AIG, but on a massive global scale. On September 16, 2008, just one day after Lehman Brothers filed for bankruptcy, AIG was on the edge of collapse. The Federal Reserve stepped in with an $85 billion loan to keep AIG afloat. This was not a gift, it was a loan, and it came with strict conditions. The government essentially took a large ownership stake in. The initial $85 billion wasn't enough. As the crisis continued and AIG's losses mounted, more government aid was needed. Over the following months, that number grew to $182 billion, making it the largest bailout of a single company in U.S. history. The government basically pumped money into AIG to ensure it could pay its obligations to the banks and other financial institutions. Was such a massive rescue of AIG necessary? Yes, it was, because AIG hadn't just insured credit default swaps of only one bank. It had insured everyone's swaps, like Goldman Sachs, Merrill Lynch, Deutsche Bank, and more. If AIG fell, the ripple effect would have destroyed the entire financial system. So the US government took control of AIG, acquired an 80% stake, and replaced its CEO. The goal wasn't just to save AIG, it was to stop the entire economy from unraveling. Over the next few years, AIG slowly sold off assets, restructured its operations, and returned to a more traditional insurance business. By 2012, the US Treasury had fully exited its position in AIG, with the government ultimately earning a small profit on the bailout. But while the numbers from AIG recovered, its reputation never recovered. AIG is still remembered as one of the most reckless players in the 2008 financial crisis, not because they broke laws, but because they simply didn't understand the monster they were feeding. The 2008 crisis was very complex, and there are many parts to this crisis, such as Lehman Brothers' collapse, how Warren Buffett saved Goldman, and how Michael Burry and others managed to make millions from the crisis. All of this I have explained in this playlist. I recommend you watch this playlist to understand everything about the 2008 crisis.